Silver doesn't have a finite supply. The cost to create more silver is not denominated in time. The ingenious thing about Bitcoin that Satoshi solved is in order to drastically increase the supply of Bitcoin and create a really inflationary period for Bitcoin and dilute everyone in a short period of time, you'd have to solve for time travel. I'm not joking. I'm not being theatrical. That's dead serious. It's denominated in time. So the man that can hyperinflate Bitcoin is the man that can travel in the future in 10-minute intervals. Unless you can solve time travel, Bitcoin is unbelievably secure at a predictable issuance that is not inflationary. Silver is not.
Before we get into this, it's important to understand why this conversation suddenly feels urgent. Over the past year, markets have sent mixed signals. Crypto, once defined by explosive upside, has been volatile, quiet, and psychologically draining for long-term holders. At the same time, silver and gold have surged, breaking levels many investors haven't seen in decades. For people watching from the sidelines, it's easy to mistake price action for proof. Charts go up, narratives follow, and slowly, a familiar idea starts creeping back in. Maybe hard assets like silver were the real answer all along. That emotional pull is powerful, especially when Bitcoin isn't rewarding patience in the short term. But this is exactly where markets tend to mislead people. Price performance feels like truth, but it isn't. What you're seeing is not a debate about which asset is winning right now. It's a deeper question about what money actually is and what role it's supposed to play in society. This is where Jack Mallers enters the conversation. Instead of reacting to headlines or charts, Jack goes back to first principles. He doesn't ask which asset is rising faster. He asks which asset was designed to function as money in the first place. What properties does real money need? What breaks when those properties are missing? And why do commodities that look strong on a chart often fail when tested over long periods of time? What you're about to hear isn't a prediction, it's a framework. And once you understand that framework, short-term market noise stops feeling like evidence and starts looking like distraction.
The point of this episode is Bitcoin is money. It's designed to be money. Something like silver is fundamentally not good at money. Why? Because it's a commodity. And I will guarantee you silver falls and is not able to sustain price levels like this for a sustained period of time. As we know, if we know something about markets, it's that prices move. We know that. As Bitcoiners, we know that. Volatility is natural. It's like entropy. That was part of the last episode, right? But things like commodities, things we consume, things like real estate, which we'll get into in a second, are not money. We monetize them because this new fiat regime forces us to monetize things around us because the money itself that our government issues is broken, but they themselves are not meant to be money. So let's get into it. So for those that have been living under a rock, see this tweet here. Breaking, silver prices are exploding due to severe global supply shortage. We'll get into this in a second. The physical market can no longer meet soaring demand. And you see this silver chart. It looks like a meme coin. It is just straight up and to the right. So the fundamental question of this episode is, what actually is money? Is the dollar money? Is Bitcoin money? Is silver money? What's the difference between money and an investable good? I don't think society has a very good idea of what money actually is, the fact that it's a technology, and what makes a money good versus a money that's bad. So I have written here, good money is scarce, durable, divisible, and portable. It is hard to create, it is hard to counterfeit, and it is neutral to control it. The money that can come in my pocket, the money that I can put in my brain, in Bitcoin seed phrase, the money that I can put on a phone, the more portable the money, the more divisible the money, the more durable the money, and the scarcer the money, the harder the money, the better the money. There's something called a commodity premium. There needs to be a cost to create the money, right? For example, dollars at the Federal Reserve, it is effortless and free for them to create as much fiat as they want. Bad money, easy money, not good money. Conversely, gold, it costs money to dig it out of the ground. The question is, how much gold supply is there? We don't actually know the answer like we do Bitcoin. Bitcoin, we know there will only ever be 21 million. Gold, we don't know the answer, interestingly. There's a lot more in the ground. The problem is it costs a lot of money to get it out of the ground. And that is what actually makes gold relatively scarce. Gold is not scarce because there's a fixed supply of gold. You guys need to understand this. Gold is scarce because the gold that does exist out there, it's really expensive to go get it out of the ground, which is interesting because as the gold price goes up, it makes it more economically viable to go get more gold that we know is on Mars, that we know is underground. So you have to have a cost to create the money. In Bitcoin and Satoshi, it was an ingenious invention to use proof of work and the difficulty adjustment. Bitcoin's monetary property here in the cost to create it is the most mind-boggling, ingenious invention I've ever seen.
At this point, Jack has already dismantled a common assumption that rising prices automatically signal monetary strength. Commodities like silver don't behave the way money should because they respond directly to human incentives. When prices rise, production rises, supply expands, scarcity weakens. That's not a theory, it's how commodity markets have always worked. What he's about to introduce next is the real dividing line, the difference between assets whose supply is governed by human behavior and one asset whose supply is governed by something humans cannot negotiate with, manipulate, or accelerate. This is where the conversation shifts from economics to engineering, from incentives to physics, and it's the point where Bitcoin stops being compared to commodities altogether.
The ingenious thing about Bitcoin that Satoshi solved is in order to drastically increase the supply of Bitcoin and create a really inflationary period for Bitcoin and dilute everyone in a short period of time, you'd have to solve for time travel. I'm not joking. I'm not being theatrical. That's dead serious. It's denominated in time. So the man that can hyperinflate Bitcoin is the man that can travel in the future in 10-minute intervals. Unless you can solve time travel, Bitcoin is unbelievably secure at a predictable issuance that is not inflationary. Silver is not. Silver is not guarded by time. It is not guarded by cryptography. Silver is in the ground. It's just how much do I get paid to dig it out of the ground? And so the price of silver will inevitably crash because as the price rises, humanity, it's like a bounty for humanity. Everyone's going to go now, dig more up out of the ground. Now, the US military, Elon Musk is saying we need to create a lot more silver because it's too expensive to build the products that everyone consumes and lives on. And so silver is actually a bad money. It's a bad money because we consume it. It's a bad money because it's not finitely scarce. It's relatively scarce, depending on how much I get paid to dig more up out of the ground. Obviously, if a bar of silver is $79 and it costs me $80 to dig it out of the ground, I'm not going to dig it out of the ground because I lose money all day. But if to dig silver out of the ground costs me $40 and now I can sell it for $79, I'm going to dig more silver out of the ground until it's $40 again. Economic professors at universities, talking heads on Twitter, guys like Peter Schiff get this so fundamentally wrong because they say, I can't do anything with my Bitcoin. With gold, I can put it in jewelry, and that's why gold is more valuable. And it's like, no, you idiot. It's better that I can't eat the Bitcoin. It's better that I can't put Bitcoin in jewelry. It's better that I can't put my Bitcoins between two hot dog buns and eat it for dinner tonight. Because you guys, the money is not supposed to be consumed. If you are consuming the thing, you're not monetizing it. The money is very simple. It's what are you acquiring to save and then later exchange for things you need. It is specifically not the thing that you're acquiring to live in, to drive, to fly, to eat, to wear. Specifically not. And it's crazy because nobody in society understands what money is, the technological role it's supposed to play in the marketplace. And so Bitcoin is very different than a commodity because it is not consumed. We do not put Bitcoin in our iPhones. We don't use Bitcoin to build military equipment. And its supply does not respond to the price. Demand increases value, not production. Meaning, if you send the Bitcoin price to $1 million per coin, that does not incentivize a bunch of people to go get more Bitcoin out of the ground. You can only get more Bitcoin out of the future. because Bitcoin's issuance is paid in time. You have to pay 10 minutes worth of energy to get more coins. So it doesn't matter how high the price goes, unless you solve for time travel, Bitcoin is going to come out every 10 minutes no matter what. To flow ratio is very simple. So great minds think alike. Luke tweeted this yesterday. He says the higher stock to flow ratio, the longer physical reality can be separated from prices via paper games. The point of stock to flow is very simple. It is, and let me go back to this slide here. Stock to flow is how much existing stockpile is there. So how much supply exists of a thing, any given thing. And the flow is how much new issuance is there of said thing. And the stock to flow is how many years it would take, given the current issuance rate, to recreate the existing stockpile. Does that make sense? And so this gives you a measurement of how scarce something is, okay? And we can see platinum, palladium, silver, gold, Bitcoin. And in that order is the most abundant and the least scarce to the most scarce. For silver, given the existing stockpile of 550,000 and the annual supply growth of 4.5%, it would take 22 years for us to recreate the existing silver supply given on how much silver we're producing every year. And as the price of silver goes up, the production goes up. When the production goes up, there's more silver to sell in the market. It's more dilutive. It brings the price back down. And silver ends up finding a relative sweet spot of annual supply growth, which is 4.5%. Gold, you guys understand, gold is better money than silver. It's been monetized throughout history better than silver for this very, very simple reason. Because gold is scarcer. It has a higher stock to flow. The annual supply growth of gold is only 1.5%. It's 1 to 2%, not 4.5%. That's the only reason gold won the monetary race against silver throughout history. And you see Bitcoin is tremendously more scarce than gold even. And what's really cool is, well, what's the annual supply growth of Bitcoin? Well, it falls every about 4 years because of the halving. And then eventually the stock to flow will be infinity because there will be no more issued Bitcoin. Bitcoin's the only thing in the history of mankind that is definitively scarce, that literally has a supply cap. There's no other monetizable good ever that's had a literal supply cap. So it'll be the first asset ever in the history of mankind that has an infinity stock to flow.